Right. This is a special situation strategy, which I've happened to call strategy A. Okay, I'm giving Costco as an example. The risk warning, this is high risk. Read that again. That is not just boilerplate to say, oh, I better write that so we don't all get into trouble. I can disclaim liability. No, it is high risk. I'm giving it for your educational purposes. And it might be relevant for some of you. That's why. The prerequisites to this strategy are that it's got to be a sound, fundamental company based on valuation, growth, income, cash flow, because we don't want the company to be falling. We don't mind if it falls if the market falls, but we don't want it to have stock-specific risk if we can avoid it. That's part of the risk mitigation. Market risk, we can't avoid. You've got to have the capital to meet the margin requirements if they call margin, and you might end up having to hold for more than 12 months if need be. That's the cost, the opportunity cost of having your capital tied up. If the market becomes bad, because we know the stock is good, so if the market's bad, then you end up holding. It's a bit like owning a house. You can't sell it if the market's bad, so you end up holding longer, and that's an opportunity cost of your capital. You're basically doing a leverage takeover. Think about it, what I'm going to describe to you in a second. The return on investment, 100% on the basis if the low point were hit in the stock, that's your cost of capital, let's say, and the upside is measured against that. So if the low point is a £10,000 loss, which we're not going to take because we're going to keep hold of the stock, it's the kind of stock we'd hold on to, then the upside is a £10,000 gain, which means 100% return on the investment. Okay, that's how we're working out return on investment. We're not working it out based on the margin that we're using because that's irrelevant. Whoops. So here it is. Here's the strategy. Here's what it looks like. Okay, I've taken a screenshot here with Costco. This happens to be a spread bet account. So you've got buy over here. Now you might say, well, why a spread bet account? Why not use just actual cash? Well, actually, this is roughly about £50,000 worth of stock or thereabouts. So the problem with that is, well, do you want to tie up 50,000? No, you probably want to tie up. Well, look, that's where it is at the moment. You probably want to tie up a max of, if it drops down to there, then that's about £10,000. Well, it's 9,000. Okay, and what if it goes lower than that, Alpesh? Well, we're going to hold on to it. We're not going to actually put an actual stop in, remember. So you don't use the stop, you would hold on. The opportunity cost, not cash cost, as the stock is fundamentally sound. But you'd need that amount to meet the margin call, e.g. 10k if it fell that far. And if it fell further, you'd need more. If it fell to zero, you'd need 50,000. But it's not going to fall to zero, is it? Because it's the kind of company which is fundamentally sound. If it makes a profit, then you make 10k. Why? Well, because we set a target of here. Where did we get that target from? Well, it's a reasonable time, which we might review in due course based on the trend of where it's going. And given that our risk capital is 10k, which we've set aside in case it's called upon, because remember, the margin's only 3,000 to begin with, but we're going to set aside a whole 10k just in case it's called on. That's risk mitigation. And the time frame is, well, you should allow 3 years to make 100% return. It's not bad, right? Hopefully it'll take a year, but let's say you you allow yourself 3 years. Okay, now what are the risks? Well, the stock falls with the market beyond the stop, so you need more capital to meet the margin. Example, you're effectively here, the notional is about 50k. If you did the math, you'd work it out. So if it drops 50%, you'd need £25,000. That's why it's important the stock is sound and not likely to drop 50%. But if it did, well, there's your risk. It takes 3 years to get the return. Might not happen in a year. Might take 3 years. So again, there's a risk. Might not happen at all, even after 3 years. Might end up where it started. So there's the risk. You get the numbers wrong on leverage, fat fingers, stupidity. Archegos, the hedge fund, got the numbers wrong and blew up. Trade finance costs. You're borrowing money, remember? It's a leverage takeover. You're saying, I'm going to take over Costco, Mr. Bank. I'll put down 3k. You lend me the rest, the 50k, and hopefully the company will go up and I'll make my return. Well, if it doesn't, you've still got to pay the financing costs either way. Risk mitigation, you only use sound stocks. Value, growth, cash flow, income. So these are ones which I look for and select. Trend has got to be in place. We check qualitative news as well. We don't just look at the quantitative factors of valuation, growth, income, Sortino, alpha. We'll check statistical distribution to make sure that the stock tends to be skewed towards and positively biased with low volatilities as well if we can help it. So you can see all the risks that are inherent in this. Do you still want to do it? 99% of people say thanks, but no thanks. Okay, but I just want to explain to you how leverage can be used, and private equity firms do this with private companies, okay, when they do leverage buyouts. But it's just an explanation of how to do it with listed companies when you're a smaller retail player. Have a look at the numbers and they'll sort of help explain. Now, I'm not going to answer questions on this right now because it's still in draft format, and I'll probably add more information because some of you will blow my head off with questions. I will come back to questions later because I'm going to improve this. It's just draft one that I wanted to explain to people. Ultra high risk for the reasons that I've mentioned. So the things most people get wrong is they focus on margin. They think things can't go any lower, and they blow themselves up as a result. And they think they're going to get this return in a week, not in 3 years. All of those typical risk increasing behaviors, which leads them to lose money. All right. So now I've given you a ton of risk and hopefully scared the bejesus out of you. You won't do it. Because if you feel for 1 second scared, you shouldn't do it. Right. So just wanted to explain that to you. So how one part of investing works.